This is the most important thing you will hear today. The U.S. housing market is experiencing an unprecedented surge, with home prices reaching new record highs. In this video, we're diving into the latest June data to unravel what's driving these record-breaking prices, what this means for you as a potential buyer or investor, and whether we're truly on the brink of a housing market crash or just witnessing a new normal. Buckle up because the insights you're about to gain could change your perspective on the real estate market. The latest housing market data for June has been released, and the numbers are making waves. Home prices across the U.S. have soared to new record highs, with a noticeable increase of $289 month over month. Year over year, the median sale price has risen by 4%. This significant spike in home prices has many people questioning whether we're on the verge of a housing market crash or if this is just a temporary phase. To understand this better, let's take a closer look at the trends over the past 5 years. The 5-year chart of median sale prices clearly shows a persistent upward trend. This continuous increase has set new records, raising concerns and speculations about the stability of the market. But what's driving these price hikes? Several factors contribute to the current state of the housing market. First, inventory levels remain notably low. As of June, there are 1.77 million homes for sale, a slight improvement from last year's 1.56 million, but not significantly higher than 2021 and 2022 levels. When we compare this to pre-pandemic inventory, which was around 2.38 million, the current inventory is still down by 25%. This constrained supply is a major factor keeping home prices elevated. Despite these figures, some argue that the market might be on the brink of a crash. However, it's important to approach such claims with a critical eye. Many analysts and experts have been predicting an imminent crash for years, but the market has remained resilient. The rise in home prices might seem alarming, but it's crucial to understand that a market crash involves more than just rising prices. Let's delve deeper into the specific concerns that are often raised. One common argument is the perception of a potential crash due to rising home prices in states like Florida and Texas. While it's true that inventory is increasing in these regions, the impact on prices has not been drastic enough to suggest a crash. In fact, when we compare current prices to pre-pandemic levels, it's evident that they remain high, indicating a robust market rather than a collapsing one. Another point of contention is the dramatic drop in listing prices. While it's true that listing prices might be coming down, this metric can be misleading. Anyone can list a property at an inflated price and then reduce it to attract buyers. What truly matters is the final sale price. If homes are selling close to their listing prices, the market remains strong. Therefore, focusing solely on listing prices may not provide an accurate picture of market health. Inventory levels are a crucial factor to consider. The current inventory of 1.77 million homes represents a modest improvement from last year, but is still significantly lower than pre-pandemic levels. The limited supply of homes on the market continues to support high prices. Even though inventory has increased slightly, the month-over-month growth has been minimal, with a rise of less than 1%. This indicates that despite some improvements, we're still facing a constrained supply, which contributes to the high prices. Mortgage interest rates also play a significant role in the housing market. Currently, the average 30-year fixed mortgage rate stands at 6.8%. This rate has remained relatively stable, as the Federal Reserve has kept the Fed funds rate unchanged. There's anticipation of a potential interest rate cut later this year, with projections suggesting a 0.25% reduction. However, this anticipated cut is unlikely to have a dramatic impact on the market in the short term. The Federal Reserve's stance on interest rates is crucial for future market trends. While the Fed is projected to start cutting rates in September, the cuts are expected to be gradual. For the remainder of 2024, mortgage rates are likely to stay within the 6% range, with potential improvements in early 2025. This gradual approach to rate cuts means that refinancing opportunities will improve, but the changes may not be substantial enough to trigger a major shift in the market. Additionally, let's examine the percentage of homes selling above their list price. Currently, 35.1% of homes are selling for more than their asking price. This figure has flattened out compared to previous months, indicating a stable market. While the market isn't experiencing the frenzied activity of 2021 and 2022, it remains competitive. Homes continue to sell for close to their list prices, reflecting a strong demand. Migration patterns also provide valuable insights into the housing market. Cities like Boston, Chicago, Washington, D.C., Seattle, San Francisco, New York City, and Los Angeles are seeing significant outflows, while migration to Florida and Texas is cooling. These shifting patterns can impact local housing markets and should be considered when evaluating overall market trends. Looking ahead, it's unlikely that we'll see dramatic price swings in either direction for the rest of the year. Inventory levels may improve slightly, but not enough to cause a significant drop in home prices. The market is expected to remain stable, with home prices staying elevated due to continued low inventory and stable mortgage rates. As for affordability, the situation remains challenging. The Home Affordability Index is at its lowest point due to inflation and high interest rates. To achieve affordable housing, several factors need to align. Home prices need to decrease, wages need to rise, and interest rates need to fall without driving up home prices. Achieving this balance is a complex task, and it's unlikely that we'll see significant improvements in affordability in 2024 or early 2025. In conclusion, while home prices have reached new record highs, the U.S. housing market is not on the brink of a crash. The current market conditions reflect a combination of low inventory, stable mortgage rates, and continued demand. It's essential to stay informed and realistic about the state of the housing market. Understanding these dynamics can help you make more informed decisions as a buyer or investor. Thank you for joining us for this comprehensive housing market update. We'll continue to provide you with the latest insights and trends to keep you informed. Stay tuned for more updates, and remember to keep an eye on the market as we navigate these evolving conditions.